Given all we've heard about inflation, of course, it's front and center for investors. Put the data into perspective, because I think that there is a lot of skepticism out there on how fast, and how much risk there is to the inflation story right now.
Well, it's great to see you. Thank you so much for having me back. I think that if you want context, we can go back to the start of the year. At that time, interest rate futures expected that at today's FOMC meeting, the Fed would be announcing its third rate cut of 2024. So obviously, the pace of disinflation has been a lot slower than was expected at the start of the year. But a lot of that has to do with the economy proving to be much more resilient in the face of these seemingly very high real interest rates than many expected at the time. And so to me, with core inflation still at 3.4% on CPI, probably 2.6 on PCE, as we'll see at the end of this month. But what it suggests is that 5% base rates are actually a lot closer to normal than anyone would have expected 6 or 12 months ago.
Now, it's interesting, Jason, and I think that you've been a pro at this, particularly because of your former experience in Washington. To what degree does the fiscal start to get into the way of the monetary policy? Because there has been a lot of concerns from both sides of the aisle about government spending.
Well, you don't hear much about it in the campaign, do you? And so, yes, you hear talk from various quarters, but it is remarkable to think about a fiscal deficit that is approaching 7% of GDP at full employment. Of course, what that implies is if the economy were to hit a recession, tax receipts were to fall, transfer payments were to increase, you could be looking at a deficit of 8, 9% of GDP. Right now, the deficit is so large that the after-tax incomes of households and businesses is about $1.1 trillion larger than it would be if the debt were on a sustainable path. So of course, to say this is working at cross purposes with a Fed trying to cool the economy and prices is an obvious understatement.
Now, how do you think about this in terms of short-term versus long-term interest rates? Even though you do see a significant cooling in yields today, 2-year, 10-year, where does that go moving forward, particularly when you look a little further out on the curve?
Well, I think the big story over the last 12 months is the extent to which the Treasury has been funding the deficit in money markets. So again, over that 12-month period, the Treasury has raised about $2.6 trillion in cash on net. Of that, $1.9 trillion has come from T-bills, so over 73% of issuance. This has kept long-term yields lower because there just hasn't been the same note and bond issuance. Typically, bills only account for 15% of the funding mix. So, at some point, they're going to have to turn back on that note and bond issuance. You can't have the weighted average maturity of the Treasury stock getting shorter and shorter, inside of 5 years would be coming very soon if they don't term out the debt to some extent. And I think the big question is, what is the price at which this market is going to clear? What kind of yields, when this issuance gets turned back on, are we going to see? And I think it wouldn't be terribly surprising to think that it's 50, 75 basis points north of where we stand today.
It's interesting, Jason, I think you heard us talking to Gene Sperling as well. We're talking about the resilience of the economy. You had mentioned it as well. What is the bigger focus heading into the election cycle? The strength of the jobs market here, or the level of inflation being experienced by Americans?
Well, I think if you look in Europe and the votes that occurred there, this cost of living shock is really weighing on the electorate's mind, of course. Depending on how it's measured, everyone's price basket is somewhat different. A median household, lower income household, higher income household, of course, they've had different experiences with wage growth over the past few years. But a typical household could have seen cumulatively something like a 7 to 8% decline in living standards, just in terms of the decline in real incomes as a result of this cumulative increase in prices. And I think that's important also when we think about inflation slowing, because of course we're talking about the change in the price level. Many voters say, I don't see low inflation, because they're thinking about the actual price level itself, in many cases up 20%. So to say that prices are only increasing 3% annually from a 20% increase is something that also is not terribly satisfying from their perspective.
Now, how do you think about this in terms of the path forward? On one hand, even if you have a promising inflation print today, I believe you're one of the people that has drawn concerns in the past about the neutral rate. So how do you pair what we're seeing in the existing data with the long-term trajectory of pricing in this country?
Well, I think in general, when you have a fiscal policy mix like this, when you see the economy, at the start of the year, people thought real rates in excess of 2% was going to suffocate economic activity. Of course, that hasn't happened. So that suggests that a 2% real rate over time is something the economy can withstand. If you add 2% inflation to that, once the Fed gets back to target, you could think neutral rates of 4% or slightly higher is what's reasonable to expect. So while today's inflation report makes one or more likely two rate cuts this year very likely, I do expect that, and certainly September is in play, how much space does the Fed really have to cut relative to, again, that neutral rate? And I would think that there's probably about 4 cuts we could agree to get down to, a range of 435. But people betting on cuts below that have to be expecting some sort of financial shock, contraction in activity. That's something that doesn't look like it's going to take place naturally, again, given how resilient the economy has proven under these seemingly high real interest rates.